Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 23rd, 2022. I hope you are enjoying the beginning of your weekend. Appreciate you being here, appreciate you spending the time. Well, last week was an incredible week of volatility and selling. My gosh, I hope everyone out there is staying safe. I really hope everyone is position sizing their swing trades or however they're trading based upon the volatility. Volatility has increased dramatically over the last month, and a big part of my trading is position sizing based upon the market's current volatility. If the market volatility is higher, I trade fewer shares. If the market volatility is lower, I trade more shares. And of course, last week was a big week down. Of course, Thursday and Friday were almost epic. So if I can suggest anything, if you can please lower your position size right now based when the volatility is so high, I think it will really serve you. I really do. If market volatility is at, let's just say, a 1 and you normally trade 500 shares, okay. But if market volatility increases by twice, then your normal shares, the amount of shares that you buy, you're not buying 300 or 500 anymore. I mean, you are, but in reality, it's like buying double. If volatility triples, then your regular position size is like tripling. Okay, so something to keep in mind. And I have a new position that I took on Friday, and I'll show you how I position size based upon current market volatility. So anyway, this is what we're going to do today. We're going to go through the current positions that I traded last week, both the open and closed, when I bought them, why I bought them, where I got out, if I'm not out, how I'm going to manage them going forward. I do trade on multiple time frames, daily, weekly, monthly time frames. Generally, it's a good idea. I think it spreads out the risk of your trades with different time frames. It's a big part of my trading. I like to trade monthly charts. I like to trade weekly charts. I like to trade daily charts. I like to trade intraday charts as well. I day trade all day long. And I do think it helps your trading to trade multiple time frames, so you don't just have all your eggs in one basket on one time frame. With the volatility and the move that we had last week, well, dailies, weeklies, I guess not monthlies, not doing so hot tamale. It's been a difficult year for swing trading, for sure. We a month ago or so, month and a half ago, we had a nice rally, but other than that, swing trading has been very difficult. But remember, there are times where you never think you're going to make another penny in the market. There are times when you feel like you're never going to lose another penny in the market. And right now is kind of one of those times where you feel like you're never going to make another penny in the market. But the market's dynamic. It goes up, it goes down. Eventually, we will get to a point where some buyers will be interested. Don't know when, don't know where, don't know which stock, but it will happen. But if you're out there, if you've had a bad trading year or you've had a bad, at least trading month, take some comfort in the market does go up, it does go down, and we'll get to a point where we have another rally sometime. That I guarantee. When, I don't know. But if you've had a difficult time trading, hang in there. Know that even the best traders in the world go through these drawdowns, go through difficult times. If it wasn't difficult and it always went up, of course everyone would succeed at trading. But trading is very difficult. The dirty little secret in trading is 85% of people who trade lose money trading. And it's true. Yeah, I can see that for sure. But, we have to do a few things in order to put the odds in our favor. Position size correctly based upon volatility. We need to look for levels, current levels, whether they're RSI levels, MACD levels, range support levels. We need to find levels to key off of. We need to have a line in the sand so we know when we're wrong, and if we're wrong small. If we're right, and we stay with it. We need to know overhead resistance levels. We need to know how to do trailing stop methodologies. There's a lot to trading, everyone, and I'll talk about this at the end of the podcast, but I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course. I think the best way to learn anything is one-on-one, and 5 sessions. Each session is 3 hours. So, if you're interested in this, just send me an email. Email's in the link of the description. So, all right. So before we get started, I should follow up after we take a look at my current positions and how I'm managing them. Then we're going to do a little bit on trader psychology. Super important right now, probably the most important time. There's a lot of emotions being evoked with the market going down. This causes people to trade certain ways. People are scared. There's a lot of volatility there, but on the other hand, there's also a lot of opportunity there. But trading psychology is very, very important, everyone. You have to learn how to trade. You have to understand the technicals, entries, exits, all that kind of stuff. But at the end of the day, you have to follow your plan. And following your plan is easy when things are going great, but when they're not, that's when plans tend to fall apart. So that all circles back to trading psychology. And so I have a good post today from Steve Burns that we're going to discuss. After that, my good friend Frank, the trading poet, has put out a new trading poem that I thought was just great. I'd love to share that with you. And so we'll do that. After that, we are going to, I already have gone down through my watch list. I've gone down through and taken a look at some potential stocks or markets that could possibly interest me next week. Generally, stocks have to go higher, they have to go lower for me to get interested in certain levels. And so I've already gone through my entire watch list. I think I have 16 symbols that I've identified as some potentials for next week. So we'll go down through each one of those. I'll tell you what I'm looking for. I'll tell you where my levels are going to be, and possible trades that I'll take next week. And hopefully this is helpful for you to get an idea. But before we do that, I need to run the U.S. legal disclaimer. So I will be back in about 40 seconds. Thank you. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. All right, everybody, let's get started. So I'm going to go through my current positions that I still have on the daily time frame. After that, we'll take a look at the the daily positions that I closed out. Then we'll take a look at the weekly positions that I closed out, and then we'll take a look at the monthly positions as well. All right. So, all right, this is TLT open position. I bought this back on the 21st of April. Signals were as such: under 30, over 30. More importantly, this is a higher low under 30 over 30. You can see back here on the 19th, we went under 30 over 30. It came from a lower low. That's still a valid signal, but I like the higher lows better. I like the higher lows better for anything. Closes back over the 200, 250, 300, 30 RSI. But just to clarify, back here on the 19th, we went under 30. We closed under 30. We closed over 30. Okay, valid signal. But the next day, which was Thursday, we went under 30 again and closed back above the 30. But you see how it was higher than the first time? So that's really why I took the trade. I did take the trade here at 120.61. It's 119.99. So it is down currently right now about 0.5% is all. Grateful for that in the market that we've had here. But right now, the RSI is at 30.07. If it closes anytime next week, if it closes under 30 RSI, that will be my signal to get out. It's never fun to get out. You always kind of want to like hold and hope that, oh man, if I get out, it's going to go right back up. And I've had that happen to me thousands of times, literally thousands of times. I've bought something, my stop told me to get it out, I got out, and it just went rushing out without me. But there are times where you get out, where you're supposed to get out, and the market continues down, and you're glad that you did. And a lot of times, yes, things will come back for you, but there are those certain times in the markets where it just heads down, doesn't stop going down, and you are really glad you took that initial stop. I can promise you that. So currently open position here on TLT. Higher low under 30 over 30 is why I took the trade. I took it at 120.61, 119.99, but still currently holding the 30 RSI. You may notice that I have an orange line up here. This is my trailing stop level. If and when it gets to my trailing stop level, then I'll switch into a different mode so that then it will be profitable. I don't want to give all those profits back, so I'll institute my trailing stop methodologies, but only until it gets here. Down here, what's this line? This line is my emergency stop. My emergency stop is always the value of 2 ATRs below my entry point. I have a designated a dollar amount loss that I'm willing to lose, and if we get down to my emergency stop, that's how much I will lose. Doesn't matter as far as like the percentage move down. Well, I'll show you on Google, because I took Google. That's the next trade, and I'll show you exactly because it's brand new. So anyway, down 0.5% on the TLT trade, looking for a close under the 30 RSI. All right, here we go. This is what I was talking about, Google. So this is a new trade on Google that I did take on Friday. Why did I take it? Well, under 30, over 30 RSI. You can see it's 30.54 right now. It went under the 30 intraday. There were no more sellers at that point at that time, and that is a level. 200, 250, 300 SMAs. Those are levels, important levels that I like to key off. The 30 RSI is a very important level. We did go under 30 and over 30 here. You can see I have my emergency stop here. I have my trailing stop level up here. My end of day stop level will be a close below the 30 RSI, right? Because that's why I took the trade. It went under 30 and over 30. That's why I took it. On Monday, if it closes at 29.99, what am I going to do? I'm going to get out, right? Because I want to have a small loss if I'm wrong. It could be a huge loss, right? But if it gets down to this level, then I am going to get out. So earlier in the podcast, I was talking about volatility and position sizing. So this is let me show you exactly the process that I go through whenever I enter a new position to know where my maximum allowed loss is, to know where my end of day stop is, to know where my trailing stop levels are. So first of all, you have to take a look at your account and you have to go, okay, how much money do I have in my trading account? For this example, let's just say it's a hypothetical $50,000 in total capital. A good rule of thumb is 1% of your capital is your maximum allowed loss on any one trade. So what's 1% of 50,000? Well, it's $500. All right, so my maximum allowed loss on any one trade is going to be, in this particular example, $500. Am I going to hit that $500 loss very often? No, I'm not. Only about 5% of the time, because I'm going to put the maximum allowed loss very far away from my entry. Does that mean that I'm going to hit that and I'm in the trade? I'm in the trade to the downside, always to lose 500? No, that's my maximum. Your end of day stop will kick in where you'll generally lose a significantly lower amount than that. So let's go through here and take a look. So I bought this at 24.0313. Now, when I saw this and the market was closing, what was I thinking? I was thinking, okay, let's take the maximum allowed loss. Again, in this case, let's just hypothetical $50,000, 1% is 500. Take $500. and I divide it by the value of the 2 ATR. This is one ATR is the average true range that a stock should move or a market should move in any given day based upon the last 20 days. Well, this is 2 ATR, so this is 2 times that. This is 2 standard deviations away from where I'm entering. I want to put it outside of noise. Any place within 1 ATR is noise, so I want to put it outside of noise. So 2 ATR value, I take the $500, which is 1% of my total trading capital. I divide it by the value of the 2 ATR, divided by 135.07. This is going to tell me to buy 3.7 shares. All right. I'm going to round that up to 4. So that makes me buy 4 shares. Now, if I had a $100,000 account and 1% of that would be 1,000, do the same thing. 1,000 divided by the value divided by 135.07. What's it going to be? Well, it's going to be 2 times, right? Because it's double. So, but in that case, we have the 500 divided by 135.07, telling me to buy 3.7 shares, or I'll just round up to 4 shares. So that's how many shares I'm going to buy. So if I have 3.7 shares and it moves $135.07 to the downside, how much am I going to lose? I'm going to lose the $500. Now, percentage-wise, it could look huge. I mean, if we get down to the maximum allowed loss, it's a 5.68% loss. But the dollar amount is always going to be the same. So that goes for daily trades, weekly trades, monthly trades. The percentage loss doesn't matter. What matters is, does your maximum allowed loss hit? Does it not hit? And being okay with that dollar amount loss. 1% of total capital is a good rule of thumb. I actually trade a little bit lower than that. I trade about 0.5%. So anyway, that's what I did. Google under 30, over 30. Position size for volatility. Place my emergency stop where? Exactly the value of 2 ATRs below my entry point, right? So my maximum allowed loss. Am I going to hit that very often? No, only about 5% of the time. Where's my end of day stop? My end of day stop is going to be any close below the 30 RSI. So most likely, if we go down on Monday, if it closes low, if it goes down lower, it will close under the 30 RSI, hopefully for a smaller loss than the $500 that we discussed. But I need to have that emergency stop down there just in case. All right. So under 30, over 30 is the entry point. Position size for volatility. Place my emergency stop so I know where my maximum allowed loss is. Know where my end of day stop, which is close below the 30 RSI. Orange line up here is my trailing stop level. If Google moves up to this level, which is 1.5 ATRs above my entry, right here it is, 1.5, 101.31. I take my entry price, go above it, then that is going to be where I go into trailing stop mode, where my trailing stop methodology start to kick in. All right. Now, we do have earnings on Google after the bell on, let's see, the 26th. What day is that? I believe that's Tuesday, right? Yeah, that's Tuesday. So I don't hold through earnings, everyone. I just think it's a bad policy. I think it's gambling. It's a great way to lose a lot of money quickly. It's also, of course, to be fair, a way to make a lot of money quickly. But our jobs as traders is risk management. It's not to make money. I know it sounds crazy, right? But our job is risk management, to manage and to take care of the funds we have at the moment. Making money's nice, for sure, right? But the best way to put yourself in a possible situation to lose a lot of money is to hold through earnings. So this will be a shorter term trade for me. I am certainly going to get out before earnings because I don't want that gamble. And, of course, hopefully it goes up. But if it doesn't go up, fine. I have my emergency stop. I have my end of day stop. And again, I will be getting out of this prior to earnings. All right. So this trade, very, very slightly down because I bought it at the end of the day. It's down 0.46% because we had that sell off and I bought it a little bit right before the market closed. So anyway, that's the new trade on Google. Gold. All right, so I did buy gold back here on April 8th. I had a nice 520 crossover. This is a different type of trading methodology than the deep dip buys, which in this market we've been doing a lot of deep dip buying. I bought this when the 5 crossed over the 20. This is more of a trend type of trade. I bought it here at 181.45 and was in the value zone after sideways motion. I like that a lot. It moved up. It moved up. Remember the orange line I was talking about on the other trades? This is 1.5 ATR trailing stop level. Once it gets here, I don't do anything per se, but I do go into trailing stop mode, meaning that if it reaches 1.5 ATR trailing stop level, and then we have a close below the previous day's low, then I get out. Luckily, I did, because I got in here at 181.45. It moved up nicely. By the way, just in addition, I do take partial profits every day if it moves a certain amount from the previous day's close, and specifically the value of 0.45 ATR. So bought here 181.45. Next day moved up that amount. I always take 10% off of my current position whenever I hit a 0.45 ATR profit target. So I took some off here, I took some off here, I took some off here. So I took and locked in profits at higher levels. Whenever the market wants to give me something, I will take a little bit of it, not all of it, just a percentage. So again, 520 crossover here, got in 181.45, moved up, took profits, got to trailing stop level. So now I'm in trailing stop mode. Back here on the 14th, I took half of my position off because it closed below the previous day's low after reaching trailing stop level, which I'm really glad I did, right? Because I got out at 184.02 for half the position, plus all the profit targets that I took. Now, moved on down here. Am I still in the trade? I am, because the 5 is still above the 20. And when the 5 closes below the 20 EMA, when the 5 closes below the 20 EMA, I will exit the trade. But you can see the 5 is at 181.87. The 20 is at 181.87. The 20 is at 181.77. So the 5 is still above the 20. If it closes below, that will be my end of day stop, and I will get out. And as usual on most trades, look, here's my emergency stop. My trailing stop level came into that, and then close below. If we have a 520 cross under, I will get out of the trade. So the first portion was sold at a profitable level. The current remaining position is down 0.62%. But this is a good example of why trailing stop methodologies work well. If I would have just bought here and had no trailing stop methodologies or no profit taking methodologies, I would be down on the trade, but I'm not down on the trade, even though we are below the entry price because of the scale outs and because of the trailing stop methodology. Okay, that is the end of the current open trades. Home Depot, well, this one didn't work out, but it's a good example again of taking profits, why it's so important, the partial profits that I take. So I did buy Home Depot back here on the 19th. I bought a higher low V2. Here is day 1, day 2, day 3. Day 2 washes out day 1. Day 3 closes above day 1's close. My stop here, my end of day stop on this type of trade is a close below halfway of the washout bar. I always have my emergency stop. I know where my end of day stop on this one is, a close below halfway of the washout bar. I have my trailing stop methodology, or 1.5 trailing stop level up here. Unfortunately, we never quite reached it, but I bought here at 307.91. Next day took off like a rocket ship. I believe I hit 2 profit targets. So even though this is a ultimate losing trade, I did hit 2 profit targets and took 20% of the position off before it headed back down at profitable levels. So, you know, I'm not bragging about this in any way, shape, or form. I'm just saying, I'm just giving you an example of why I like to take partial profits. If it keeps going up, I'm still happy because the majority of my position's going up. If it goes down and I took some profit targets prior to that, then it minimizes my loss. So bought here 107.91, moved up nicely, took some profit targets. I believe I took another profit target the next day from the previous close as well. So that was 30% of the position that I took off at profitable levels. And then of course, Friday, we had the big, huge close down. It did close below halfway of the washout bar. Had to exit this trade for 2.47% loss. But again, it really wasn't quite 2.47 because of the scaling out on the way up. So that's why I'm such a big fan of that. So out of Home Depot with the close below the previous day's low for a 2.47% loss. Nvidia, well. Nvidia was a tough one. I bought back here on the 18th of April with the close under, close back over the 300-day moving average. Really good support level there in the low RSI levels as well. It held for a couple days. It held above emergency stop down here, but my end of day stops the 300. The next day it did go up a little bit. Next day it did go up a little bit. Held the 300-day moving average. You can see intraday it went below it and closed back above. But then on Thursday, I had to go ahead and get out of this trade for a loss. Let's see, I got out at 201.90. So I got in at 217.47, out at 201.90 for a 7.87% loss. Now, I know that sounds huge, and it is, but by position sizing correctly, it wasn't that big of a loss, because if I would have bought here at 217.14, my emergency stop is down here at 191.57. If you remember from the beginning of the podcast, if I get to my emergency stop based upon the formula that I told you, how much am I going to lose? Well, I'm going to lose $500. So even if it had gotten lower to my emergency stop, it would have been a higher percentage loss, maybe like 10%, but it's not 10% of my capital, right? It's just a small portion of what I allocated for that particular trade. And again, if it would have got to my emergency stop, all I would have lost is $500, regardless of the percentage move. So I am out of Nvidia. It's 31.75 RSI. I will be looking possibly, I actually have it on the list for another under 30 over 30, but we'll do that a little later in the podcast. Okay, IWM. Now let's switch over to weekly trades. Again, I do trade different time frames, right? So I bought IWM Russell on the weekly back here on the 28th of January. Under 30, over 30 was the trade. Also rejected the negative third ATR channel. Also rejected the 100-day or 100-week moving average. Nice confluence of signals there. Bought at 193.20. And as always, I have my emergency stop down here. Again, 2 ATRs for my entry. Trailing stop level up here. So I bought here at 193.20. Been in this trade for quite a long time. Moved up nicely. As it moves up, I take partial profits, as discussed before. We finally got up here to my trailing stop level, which means I go into trailing stop mode. Now, an under 30, over 30, if I reject the 50 SMA or the 50 RSI above me, that is my decision to take half of my profits off, and I'm glad I did. I took half off here at 208.43, which is substantial because right now it's 192.71. So I took a nice profit there, and I have a rule: if I have an under 30, over 30, and it moves to my 1.5 ATR trailing stop level, then if it ever moves back to my entry, I get out at break even, and that's exactly what I did. So not a bad trade, moved up, took profits, rejected the 50 RSI, got out of half, locked in a nice percentage gain there, but then Friday, when it got back to my entry point, I got out for a break-even trade. And break-even trades don't sound too exciting, but they are a good thing. Especially if you can find a trader that can take a break-even trade, you know there's some maturity there instead of letting it turn into a big loss. But those are my rules. All we have in trading are rules, and that's why I got out of the remaining part of Russell at a break-even. IBB. All right. Well, IBB bought this last Friday. I like the higher low rejection, intra-week rejection of the 200-day moving average. Bought this here at 131.01. My end of day stop is a close below the 200. Well, we closed way below the 200, and so I did take a loss of 6.11%. Emergency stop down here. Again, if I would have got down here, how much would I have lost? Only $500. So big percentage loss. But dollar loss, not big. So out of IBB. Facebook. Now this is a perfect example This was a horrible percentage loss, but it was not a big dollar loss. Why? Because I position size based upon the market's current volatility. Bought here, a nice confluence of signals, under 300, over 300, V2 entry signal. V1s, V2s, kind of my bread and butter, great entry signal. If you'd like to learn more about them, go to my YouTube channel. In the playlist, there's a playlist that talks about V1, V2 entries. And so go there, check them out. They're all free. But at under 300, over 300, plus a V2, undercut here. So great setups all the way around. Bought at 216.01. Did move up, has moved up, has moved up. Did take some profit targets, luckily, which helped mitigate this loss. My end of day stop closed below the 300 weekly. Well, we did close for a loss of 17.42%, again, which sounds horrible, and it is, but dollar-wise, it's not, because when I entered the trade, I said, okay, what's my maximum allowed loss? Well, with my hypothetical $50,000 account, 1% of that's $500. I take $500, I divide it by the value of the 2 ATR. It gives me a very small amount of shares to trade, because percentage-wise means nothing. Dollar amount means everything, right? So my maximum allowed loss is $500 if it gets to my emergency stop. Well, emergency stop so far down here. I mean, if we actually look at how far the emergency stop was down there, it was down 29.19%, right? But how much would I have lost if I would have got there again? Only $500. So the percentage doesn't matter, right? It's because I position size based upon volatility. And that's why at the beginning of the podcast, I was kind of begging and pleading with you to reduce your position size when this because the market volatility is so high. And that's the beauty of taking your maximum allowed loss, dividing it by the value of the 2 ATR. So yes, horrible percentage loss of 1.72%, but in reality, like a $300 loss. So not that big based upon the 500, right? The $500 maximum allowed loss. So I am out of Facebook. And earnings are coming up as well. So out of Facebook on the weekly. All right, last but not least, love, which is Southwest Airlines. This is a monthly trade. I did buy Southwest Airlines on the monthly back here on the last day of January. So I've been in this trade for 3 months. Nice confluence of signals. We have a V2 entry. Here's day one, or bar one. Bar 2 goes below bar 1 by at least a quarter ATR. Bar 3 closes above bar 1's close. Cherry on top, it also rejected the 100-week moving average. I got in at 44.77. Right now it's 46.85. Of course, placed my emergency stop down here. My end-of-day stop closed below halfway of the washout bar. You can see ever since I took the trade, the next month went below, closed back above, went below, closed back above. Even this month went below my emergency stop, closed back above. Closing is the most important to me. Did hit one profit target this month. You can see I have 3 green lines, one here, one here, one here. Those are my 3 profit targets. They're 0.45, the value of 0.45 above the last bar's close. And you can see, went up here, got out of a portion, how much? 10%. At 48.43, which I'm glad I did because it's 46.85. And so currently, and then the second profit target's up here at 52.10, 55.77, but we're almost to the end of the month, so I'll have to recalibrate the profit targets. But just wanted to point out taking the 10% off at the profit target level. If it goes crashing down from here, I'm glad I took it there, right? So anyway, this trade so far, glad to be positive, up 4.89%. So that is a rundown of the daily trades, the weekly trades, and the monthly trades. So let's switch our attention a little bit before we get to the charts, before we start looking at some possible entry levels for me next week. Let's switch gears, talk a little bit about trader psychology. Again, in this kind of market where the market's going down, there's a lot of emotions being revved up. There's nothing more important than trading psychology, nothing more important than position sizing correctly, picking your levels, getting out quickly if you're wrong, staying in, having a plan to the upside. You have to have a plan, and you have to have rules. And that's why when I read this is from Steve Burns. This is my great friend Steve Burns, wonderful trader, great author. Please go check him out at @SJosephBurns over on Twitter. You can also check out his website, New Trader U. That's New Trader and then the letter U.com. He has great content, great courses, wonderful trader, great author. Everyone knows Steve Burns. I've studied with him one-on-one, and I've learned so much from him. And thanks, Steve. Appreciate that. But I like this post that Steve shared with us. This is by Dr. Van Catharp. A mistake is when you don't follow your rules. Okay? If you don't have rules in trading, everything you do is a mistake. You have to have rules. It needs to be rule-based. You have to have good risk to reward ratios. You have to position size correctly, but you have to have rules, whether to the upside or the downside. If-then statements. If this happens, then I'm going to do that. If that happens, then I'm going to do this. And you have to stick with it. But Dr. Thorpe is completely correct here. A mistake is when you don't follow rules. Okay, I break rules sometimes. Yes, I have to admit it, but it's a mistake because I broke the rules. But I do have rules. But if you don't have rules in trading, everything you do is a mistake. So get yourself some line in the sand type of rules. 200-day moving average. I'm staying in it while it's above it. I'm just going to cash and getting out of it if it closes below. That's a rule. That's a great rule. That simple rule there will make you a lot of money over time. But people's egos get involved. They don't want to take losses. As long as you don't take the loss, you feel like you didn't really take the loss because there's hope, and hope springs eternal for everyone. But man, a lot of times that will work, but there's going to be those times where you can get wiped out. Please, 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 everyone, get yourself some rules. If I could suggest one, pick a line in the sand, pick that support. If you lose, just get out quickly while the loss is small. If the loss is small, it's easy to take a small loss. You know that, but it's really, really hard to take a big loss because you keep hoping it's going to reverse. You keep hoping it's going to reverse. Don't get stuck. It's a vicious trap. It's a rocky road. So a mistake is when you don't follow your rules. If you don't have rules in trading, everything you do is a mistake. So please get yourself some rules. In my course, I teach all of my rules, of course, and I'm happy to teach you those. If you have any questions about, coming up with some rules, I'm glad to help you. Even if you don't take the course, just leave the comments in the below. But one more time, it's so important. A mistake is when you don't follow your rules. If you don't have rules in trading, everything you do is a mistake. Well, we don't want to do mistakes in trading. It's very important to minimize our mistakes in trading. So please get yourself some rules. Thank you, Steve. Thank you, Dr. Thorpe. Okay. Again, real quick, before we start looking at charts, wanted to go over a trading poem here from Frank. You can follow Frank at FrankOD over on Twitter. Do yourself a favor. He posts one of these every day. I just love them. When I was doing my live stream on YouTube for 3 years, he came in, posted one every day. It was just amazing to see someone be able to just like come up with a poem that quick, that fast on the fly. What a gift, Frank. Today's market poem. There's joy with the gain, and a loss has its pain. For these are emotions a trader must train. Markets play hard and rules keep us sane. Still, feelings are something we can't always contain. An emotional roller coaster is a ball and chain. Well, that about sums it up. There is joy with a gain, for sure. And there's loss with a pain, right? Correct. For these are emotions a trader must train. Markets play hard and rules keep us sane. Back to the rule portion, right? Markets play hard and rules keep us sane. We want to stay sane. That's why you need the rules. Still, feelings are something we can't always contain. Hey, I feel feelings very deeply, but I'm pretty good at following my rules because I want to stay sane. Doesn't mean that if I have a loss, it doesn't hurt. It does. I'm an emotional person. It does, but I try to follow the rules the very best I can. I mean, 99.9% of the time I do. Every once in a while, just like everyone, I do break a rule. I have to admit it, but most of the time I do follow my rules. But markets play hard and keep us sane. And rules keep us sane. Still, feelings are something we can't contain. It's okay to have the feelings. Just follow the plan. An emotional roller coaster is a ball and chain. Yeah, it really is. And that's what trading is. And if if you decided to make trading a career, it is going to be a roller coaster for sure, which I'm sure everyone is aware of right now because of what's happening with the market. Okay, so that's that. So I have a list here of 16 different stocks that do look interesting for me next week. Let's take a look. Doesn't mean I'm buying them right now this second. Stocks generally have to move up for me to get interested or move down to a certain level to get interested. I know it sounds weird, right? Like, well, why wouldn't you just buy it right here? Well, there's certain levels. If they can move above certain levels, that's bullish. If they can reject levels to the downside, that's bearish. So here we go. Here is Apple. Well, I love buying Apple at the 200-day moving average. We can go back here. Look, this is the last time I bought Apple back here on 314. I was patient. I waited for this trade. Close under 200, over 200. My risk was small from here to here, right? But look what happened. Took off beautifully, and that was a massive, big trade. My trailing stop methodologies got me out of the trade, got out here actually, got out at 174.69 with a close below the 5 EMA after reaching the 65 RSI. So went down next day. I was like, oh, went up. Oh, well, headed down big. So last time at the 200-day moving average, it respected it, it held it, and we had a great swing trade there. Now, of course, we've moved back down, but look, we're coming into the 200-day moving average again. So if I get a rejection of the 200-day moving average next week, I will enter the trade, just like I did over here. Or if it goes lower, I will key off of the 250-day moving average if I get a rejection or a close under, close over. Another great level. Another great level from there down there is the 300-day moving average. So I have 3 levels that I'm going to key off on. I like the 200 here. It's right close to the negative third ATR channel. 92% of prices hold or tend to go up at the go sideways or tend to go up when they get to the negative third ATR channel. Conversely, 92% of prices stop going up, go sideways, or go down when we get to the positive third ATR channel. And look, here's the third ATR channel here. Look, we got right up to it. That was about it, and down. Well, now we're on the flip side of that. Now we're at the bottom of the channel, down in the negative third ATR channel, and we have a nice confluence here of the negative third ATR channel and the 200. So next week, I will definitely be keying off, looking for Apple right here, about the 158 level, or more precisely, just whatever the value of the 200-day moving average is. If it slices through, I'll look at the 250. If it slices through that or rejects that, I'll look for the 300. We do have earnings. I mean, this muddies the water a little bit. Again, I'm not going to hold through earnings. So if Apple on Monday goes under 200, over 200, well, I will buy it. But will I hold it through earnings? No, I won't. I will get out prior to earnings. Don't want to hold through earnings. So really like Apple here next week if we can get to the 200, the 250, or the 300. Advanced micro devices. Well, semiconductors have just had this huge move down. I mean, just in the last month, I mean, just AMD here in about the last month is down 30%. Holy smokes. Huge move down. Why am I interested in it now? Well, I'm not quite interested in it. I'm looking for an under 30, over 30. Here we are at the negative third ATR channel. Remember, 92% of prices tend to stop going down or go up when we get to that level, but I need a real entry point. Then my entry trigger would be an under 30, over 30 on AMD. Right now it's 31.69, so it's not really into oversold levels. And when I say oversold levels, I mean the 30 RSI level. Okay, so next week, if we get a nice under 30, close back over 30, ideally a close under 30, close over 30, a close under the negative third ATR channel, close back over the negative third ATR channel, that would be a great confluence there. But at the very least, an under 30, over 30 would give me a good risk to reward ratio. So that's what I'm looking for AMD for next week. Amazon, well, similar to AMD, Amazon is at a 37.64 RSI. Earnings are on the 28th, so that will be next week as well. So what I'm looking for Amazon is an under 30 over 30. Again, look, we're at the negative third ATR channel. 92% of prices tend to stop going down, bounce, or go up at this level. It's at the third, so why not just buy it? Well, it's not a primary trigger for me. It's a secondary trigger, or as I usually say, cherry on top, because I want the confluence. But what I'm really looking for, just like AMD, an under 30 over 30 would be fantastic. I'd have to position size, place my emergency stop, end of day stop, trailing stop levels, but that's what I'm looking for Amazon, is under 30 over 30. FCX, okay, so this is Freeport, copper and gold. What I'm looking for here, it's had a nice rally, but I mean the last few days, like everything else, has just really come down. We're at a 31.95 RSI. An under 30 over 30 on this particular trade probably would not interest me. What I'm really interested in buying is FCX here at the 200-day moving average, or potentially the 300-day moving average as well. I don't know if it's going to get there next week. It certainly could. But, I mean, look at this chart. Huge move up. Look what happened last time we went under 200 over 200. Moved sideways nicely and then had a huge rally. Is it going to do it again? I don't know, but it did show respect for these levels last time, and to me, doesn't mean it has to hold this time, but it's more likely this level will hold if it held the last time. So a rejection of the 200 next week would be a great place for me to get long FCX with a good risk to reward ratio. All right, Google. Well, we already talked about Google. I am already in Google, so with the under 30 over 30. But if it closes below the 30 RSI, I'll just go ahead and get out. But in the future, if it goes under 30 over 30 again, that would be my key to potentially get back in. And then we have earnings. This could change the landscape totally. But if earnings come and it gaps way down, I would still look for an under 30 over 30 after earnings. MasterCard. Well, MasterCard's been holding up relatively well. We had a nice move off the 200 here, which moved up nicely, had a nice tradable rally here where you definitely could have made some money. If I had taken this trade, I would have gotten out here with the close under the 200-day moving average. So next week, if MasterCard can get itself back up over the 200-day moving average, then that's a good level for me. McDonald's really been on a tear, really holding up well. You can see the 200-day moving average down here at 245. It's about $5 or so away from below where we're at right now. You can see last time back here on the 4th that we tested the 200-day moving average, the buyers did come in there. It did move up, nice tradable rally. So next week, if McDonald's can go below, intraday reject the 200, go below, close back above the 200, that would be my level. So I will be keying off of McDonald's next week at the 200. If it loses 200, I can key off the 250. If it loses 250, I can key off the 300. I really like this 300 here because look at this confluence. 300-day moving average right exactly, almost to the penny, to where the negative third ATR channel is. But first stop would be a test of the 200. If it does, I'll enter. If it loses it, I won't. If it rejects the 250, I'll enter there. If it loses it, I won't. And last call here would be a rejection of the 300. So have some nice levels below us on McDonald's to see if they'll hold. Microsoft, well, it's 35.82. Company like Microsoft, kind of tough to get under 30 over 30 on Microsoft, but when it happens, it's hard to do. You have to kind of close your nose, plug your nose. But next week, if Microsoft goes under 30 over 30, that will be an entry signal for me, just like Google was on Friday. Then again, of course, we have earnings. If I do get long Microsoft, I will get out before the earnings. Maybe we'll get some kind of run in tech into earnings. Who knows? Nvidia, so that was the trade that I had to get out of on Thursday with the close under the 300-day moving average, continued down on Friday, but we're at 31.75. What am I looking for? I'm looking for an under 30, over 30 next week on Nvidia. Pfizer, we've had a nice pullback here, see how we close below the 200? If we can close back above the 200, I would definitely look to enter Pfizer. It would give me a good risk to reward ratio and a potential swing back up. So next week, if we close back above the 200, that would be an entry point. If we head lower, then I can key off the 250. If we head lower than that, I can key off the 300, similar to Apple. Qs, well, Qs, of course, NASDAQ 100 just has been beaten up, as you can see. Buying the Qs under 30, over 30 has been a good policy for a long time. It's rare that you, on an index like the Qs, that you get an under 30, over 30. And right now it's 36.12. It doesn't mean it has to get there, but if it does, I will certainly be looking for an under 30, over 30 entry on Google. Silver, I'm keying off of the 200-day moving average here. You can see last time it touched the 200, it touched it, bounced, went up nicely. Will it do it this time? I don't know, but I think it places the odds in your favor better that it did hold last time. So I will, if and when it rejects the 200-day moving average next week, that would be an entry point for me on silver. SLV. SPY, same as the Qs. Boy, look at this move down. I mean, we just lost the 300 like crazy. It's 37.04. I'd be looking for an under 30, over 30 on SPY. TLT I already have, but as I mentioned, if we go under, if it were to go under 30, it would stop me out. But then if I got a new move back over 30, I would buy it. But currently in the trade, hope it doesn't close under 30. But if it does, I'll get out. But again, if it closes back above in the future, that will be my entry. Tesla's been very, very strong. Of course, they had really good earnings. But you know, who knows if this is likely, but if Tesla were to get down to the 200-day moving average, I would certainly buy it. That percentage-wise, that's quite a long ways away. What is that? That's about 10%, but it certainly could move. If Tesla next week, don't know what's going to happen, but next week, if we do get to the 200-day moving average, I will buy it. You can see last time over here, we had to close under, close back over, and it rallied like crazy. Right? So it was respecting the 200-day moving average. Will it this time? Who knows? But if it does, I will buy Tesla. If it heads lower, I'll key off the 250. If it heads lower, I'll key off the 300. And that's what trading is about, everyone. Doesn't mean that every level is going to hold. You can take a shot at it. If it holds, great. If it doesn't hold, get out with small loss. Check in at the next level below. And so, yeah, there's 3 levels on Tesla next week. I hope they don't go that low, but if they do, 200, 250, 300. And then last but not least is XLV, which is healthcare. Last time we were at the 200, close under, close over. We had a huge rally again. If it gets to the 200-day moving average, I will go ahead and buy there. If it loses it, I'll move my attention to the 250. If it loses it, I'll move my attention to the 300. So that's kind of the key here, is looking for levels below. You notice I didn't have any levels above this week because they are so far away and so unlikely, but there are levels to the downside. So, you know, earlier I was talking about, we were talking about V1s, V2s, trailing stop approaches, emergency stops. So, you know, in this podcast, I don't obviously have the time to go into all the nuances of everything, of all the entries, exits, trailing stop levels, position sizing. I try to cover them, but I can't go into the nitty gritty. And when I do go in the nitty gritty, it takes me about 15 hours to do that with a student. So that's why, you know, earlier I talked about that I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I've taught people from all over the world, had really good results with them, really good reviews and feedback from my students. And listen, if you want to learn everything that I know about trading, and I've been trading for 25 years, I've been through all sorts of different markets, I have different trading approaches, but in my course, the one-on-one course, I teach you all 5 of the different trading approaches that I have. Again, the course is 15 hours, 5 hours, or 5 sessions. Each session is 3 hours. That's where you get to 15. But it's very important to me that my students succeed. I think the best way to learn anything is having a one-on-one teacher or mentor to help you, and that's why I provide the lessons in this format. The course does cost $1,750, but it's worth every penny, I assure you. And so if you're interested, This is a good time with the markets like this. It's a great time to really learn how to do this. So if you're interested, there is an email in the link of this YouTube video. Just send me an email. Say, Greg, potentially interested in taking your course. So I'll reply, say, great. Hey, let's set up a free Skype call. It's not a sales call, everyone. I promise you it's not a sales call. I just want to get to know the person that I'm potentially going to be spending 15 hours with, to see if we're a good fit, to learn more about you, your trading challenges, your trading goals, the best way I can help you. It's also a good time for you to ask me questions about the course in general on our Skype call. And when we're done with the Skype call, you think about it as long as you want. I won't contact you, but one day if you wake up and you say, hey, today's the day, I really want to learn this skill, I'm going to email Greg. Great. Look forward to that email. We'll get it set up, and away we will go. Secondly, I do have an online course available at udemy.com. The link is in the description of this YouTube video. It's a great online course. It's super affordable. It only costs between like $12 and $15, but don't let the low price fool you. There's a ton of content in there for the deep dip buy stock trading strategy. If you're new to trading, maybe you're not in the position to do the one-on-ones, at least take that course. It's so good. I've had so many good reviews from all over the world, and I teach you step by step how to trade that deep dip buy strategy. And we are in deep dip buy land right now. So the link's there. I think you'll really enjoy it. And then lastly, if you like today's podcast, if you feel like it was helpful for you, all I ask is that you hit the thumbs up button. It helps to build the channel, helps keep the channel around, lets YouTube know that there's some valuable content. And if you could do that, I would really, really appreciate it. So I hope you have a good rest of your weekend. I hope you enjoy. I hope you get out, maybe get some fresh air, study your charts, do a little meditation, try to eat healthy, be good, be kind, drive safe. And I always kind of like to leave this off. Look, if we could just do one nice thing for another person every day, it really would help the world out in a big way. It would just make the world a better place. Imagine if everyone just did one nice thing for another human being every day. It would really make a difference. I would ask if you could also go out and do one nice thing for an animal today. I would really appreciate that. You know, I grew up with lots of animals. I'm a huge animal lover. They appreciate acts of kindness just like humans do. So, you know, I try to make it a goal to do one nice thing for another human being each day. I try to do one nice thing for an animal each day, and it's just good karma. It's going to make their day, and hopefully one day if you need it, someone will be there for you. So again, tough week trading this week, no doubt about it. Pretty historic. I think the Dow was down over 1,000 points at one point just on Friday. So, you know, if you're a little down on yourself in your trading, like, take comfort. Things will turn around one day. I just don't know when, but keep those, you know, position size, keep those losses small. You can't control whether you have a win or a loss, but you can control how big it is going to be through your position sizing and your levels. But, you know, hang in there. I know it's not fun to go through a drawdown, but it is part of trading. It's something we have to do as traders, but you know, the skies will get bright again, but please be careful. If I could just leave you off with one thing, be careful. Don't hold losing positions overnight. Make sure that you key off of your levels, and when you're wrong, you're out. Just get out, get on with it. Another one will come around. Another good trade will come around. So if you have any questions, you can leave them in the comment section. Do my best to get to those, but thanks again for listening. On the way out here, I have to run the U.S. legal disclaimer, and anyway, we'll regroup next Saturday. We'll see how we did, and hopefully we'll have a better week this week, but who knows. Please be careful. Appreciate you being here, everyone, and got to run that U.S. legal disclaimer. Thanks again. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.